Uh, let's welcome in our next guest, Hemendra Azari, to talk about earnings. Hemendra, Wednesday, market holiday, IndusInd Bank declaring numbers. What would you expect?
I think IndusInd Bank has not disappointed so far on its numbers. So we can continue to expect about a 25% growth in net earnings and, strong growth in net interest income. Fee income, I think, could be a little slow given, the way corporate loans and corporate linked fees are doing. But I expect IndusInd will meet market expectations, and it has to be seen like some of the other, corporate-facing new private sector banks. They may have some issues.
So, we've already spoken about, what can happen in terms of retail banking. But for something like an IndusInd Bank, they continue to do well with decent risk management, but it's in the price.
It is. Now, the entire market, I would say, is in the price, and it has been in the price even before this whole surge in the market. Because what we have seen is that earnings are still not catch up with valuations. And this has been the case both globally as well as in India. And we keep expecting that 2 quarters down the line, things will improve. But so far, those have merely been wishes, and nothing really has moved on the ground.
Right. So going into this earnings season, especially for the banking space, as you said, IndusInd would tend to, meet expectations or be in and around expectations. But some of the other banks like Axis, ICICI could be interesting. There, the predictability is very low.
Correct, because one really doesn't know, because we do know that they have a huge corporate exposure. We do know that they have huge infrastructure exposure, and that remains a big question mark. So therefore, we have to see what type of knock they will report on, net profits. It could vary anywhere between 5 to 10% to 20%, because we have seen a very rapid now contamination taking place, which in my view was much delayed. But that's what we're going to see, and that's what's going to be very interesting to observe. Because in my view, their corporate book is no different than some of these government banks' corporate book.
Right. I just wanted to understand that, you've been tracking banks for a while now. Now, till now, profitability of these banking sector was broadly in line. They never really missed, and the asset quality used to move around here and there. But now the provisioning requirements or provisioning have increased quite a bit. So their profits are getting hit, whether it's ICICI Bank, whether it's, an Axis Bank or any other major large cap private sector banks. Their asset quality is broadly stable, and there is already an expectation that it will tend to increase. Should you look at the EPS and the EPS cuts for these banks when it is happening on a constant basis?
See, in banking, the P&L, just like in many companies, is far less relevant than the balance sheet. And in particular, when you say the balance sheet, you have to look at the asset quality, and not just the asset quality, but also the credit growth. Because today what is happening is you're getting a huge retail credit growth. And I've already been voicing my concerns about this retail credit growth, because today at least the reported NPAs in retail are very less. But there is huge considerations, there are huge concerns about mortgage loans, because within mortgage you have loan against property, and that could be given for any purpose with just real estate as the security. And we all know that in the real economy, employment is stagnating, sales is stagnating, there's a huge inventory of real estate which is not being sold. And therefore, the retail incomes may not be going up very much. So, and they service the loans from the incomes. So I think it is a matter of time that even the retail credit growth will start getting impacted.
Right. And say if, there is a liquidation of this property, it may actually not yield the sort of amount that it is that is pegged in.
When you say I would expect liquidation of the real estate property, yes, because today you're finding that there are hardly any transactions taking place in the real estate sector, and therefore the pricing which is disclosed may not be the real relevant pricing, because I believe that there are very few volumes taking place. So, the whole pricing may be entirely artificial, and the prices are remaining also that high because they're getting funded from either bank finance, which is coming indirectly through mortgage loans, or from non-bank finance. A lot of these NBFCs also, I understand, getting involved. Now, how long can this whole thing be sustained? That is the interesting question to ask. And when will it crack? Because if it cracks, then we are going to see a lot more problems, because the corporate asset quality, I don't think, is going to improve. At best, it may remain at these levels. But if retail and your mortgage loan starts cracking, then there could be much more problems which analysts are not forecasting at the moment.
Right. So, Hemendra, that's about the banks and what can happen in the banking space. But if retail doesn't grow or retail, doesn't stabilize in terms of transaction happening, more construction happening, It's a bigger issue because it's a big part of the GDP. It's a big part of construction, of largely the overall job creation. All of that would then come under question mark.
Oh, most definitely, because today industry is going nowhere. Your capex in the economy is going nowhere. Your exports is going nowhere. So these are very key components of the expenditure side of GDP. Now, if your personal consumption also, starts getting impacted, then we are going to have a problem. Now, look at this. The pay commission. One of the triggers analysts are saying is that the increase in the pay commission will lead to some, higher demand, which is true. But these same analysts earlier were very suspect about any increase in government expenditure because they used to argue that one, it is wasteful, and two, it leads to inflation. Now, the same analysts are arguing that the increase in the pay commission is one of the positive triggers for corporate earnings. So I think there should be some consistency and some logic in the arguments that they put forth.
We had a UBS guest called Gautam Chichodia just some time back, and they went to a lot of second-tier, three-tier cities and tried to do some channel checks about what people are going to do with the pay commissioning arrears that they are getting. Now, majority of the answers came in that they would be looking to increase their savings because it's not a very, very high chunk that they are getting this time, unlike in 2009 and 10. How should you read into this data? Should it be positive for earnings, or how should one take it?
You see, today you want demand to increase because I've always been arguing for some time that the Indian economy, just like the world economy, the problem is of a paucity of demand. And at least for India, it is not inflation, which everyone was focused on, especially under Governor Rajan. Now, if what the UBS report says is accurate, that it is going to increase savings, then to me it is clearly a negative. Because today one of the reasons of growth that analysts are arguing is that the increased pay commission will result in higher consumption and therefore higher sales for corporate India. Now, if the retail consumer is going to save, then that is not going to deliver and that's not going to give you growth. Because in any economy, you don't want the savings to increase, you want consumption to increase. Because this very idea that a higher savings is equal to higher investment does not hold. A higher savings does not necessarily flow into higher investment. And I would also argue that you do not require savings to increase investment because the government can always borrow, unlike individuals.
Right. So how would you look at the earnings? At least for the next 9-10 months or maybe 12 months, you're not seeing any major pickup. Maybe because of the base effect, there may be a percentage growth. But otherwise, you don't see earnings meeting street estimates?
Well, Pankaj, I've been very clear in my view for the last 2 years is that you are in a situation of earnings secular stagnation. And this is going to continue for some time. I'm very glad that Dr. Urjit Patel has at least lowered the interest rates, will give some relief. But the fact is, if you want to come out of this cycle, you require an increase in the fiscal deficit. Now, already, the consensus view has been moving away from this high interest rate regime, at least in India. And globally, also some mainstream economists are coming to the view that you need to increase the fiscal deficit. I just hope that wisdom, also dawns on the Indian government that it has to do that. And until you do that, you can continue to expect this earnings stagnation of about 3% at best year on year. And, we'll keep hoping that the recovery will take place 2 quarters down the line. But I really don't see that happening.
And in terms of consumption, names like Asian Paints, names like Havells, if you don't want to talk about sector, great ROE companies with great durable, products that they have, which have continuously delivered earnings, at least they will support the numbers?
You see, that's an interesting case, as you said, that what is a way to play this in this kind of would have, some bullish and some things to buy on. You can really take any of these branded companies which have pricing power and where some critical input is a global commodity where the prices are under pressure, like oil. Now, here the only story you can really bet on is some type of margin expansion because I really do not see top line really growing in any significant manner. And with this, the very weak wholesale price index, which just tells you that corporate India does not have pricing power. So at least there, the branding gives you pricing power and the lower global commodity prices give you some margin expansion. However, I must caution that all these stocks are extremely overvalued. But since, we've constantly seen the bubble getting bigger, there is probably some room there.
Right, Hemendra. Thank you so much for giving us your views this morning. We'll look at the earnings season and then hope to chat with you again once we have a lot of these banking numbers and a lot of interesting other companies that you mentioned. That was a view coming in from Hemendra, sounding cautious about the earnings growth, but at the same time saying that flows may tend to continue.